heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York and San Francisco, this is Bloomberg Technology. Coming up, tech winners and losers. The latest earnings and investor moves as Soros and Druckenmiller, well, they sell out before the sell-off.
And the Tesla analyst who almost crashed using FSD is back with another review of the tech. We speak to Truist's Wiiliam Stein.
And defense tech is in focus. A massive fundraise for Anduril. We speak with its executive chair and VC backer about the whopping $14 billion valuation. But first, let's check in on these markets. We are having a strong day. Good news is good news again. The retail sales coming in, the fact that jobless claims are also showing a strong US economy. But yes, we might not factor in the rate cuts coming hard and fast, but there still can be room to cut for the Federal Reserve. So we're up 1.8% on the Nasdaq 100. And look, the bond market is pricing in what seems to be a more resilient economy and one where perhaps we can't cut into a fast pace, but still 12 basis point move on the bond market, a sell-off, but still movement into the tech stocks. Ed, what are you watching on the micro?
There is a lot to cram in this morning. Earnings is a part of the story. Cisco, look, it's markedly higher. Job cuts confirmed, but a strong outlook for sales and a pivot to the cloud, cybersecurity, and, of course, artificial intelligence. Later in the show, we'll get deeper analysis in-house with Bloomberg Intelligence that you'll want to tune in for. Then we go over to Asia, actually. Really interesting in both China and Southeast Asia, the earnings story. Alibaba's ADRs, those are the US-listed shares, are higher. They've been lower overnight because of a kind of weaker sales outlook that we were worried about. JD.com flying higher, the e-commerce and digital story in China strong with them up 5%, and then Grab down 6.3% on the ADRs. Ride-hailing in that Southeast Asia market, there seems to be a lot of competition impacting JD. We will go over that. And then there's all of the 13F interest in who is buying or not buying or holding or not holding or selling and reducing their stake in tech globally. Lots to discuss.
That is such an interesting part of the story today, and we're going to delve right into it. Because, look, we've got George Soros, you've got Stein and Druckenmiller. Both their investment firms actually managed to trim their holdings in the Magnificent Seven stocks before the major downturn in such tech names back in mid-July. Pretty prescient. For more on the story and other investor moves, let's bring in Bloomberg's Hema Palmer, who's joining us on the daily at the moment. Hema, look, it does feel like they managed to cool this a little bit. Tell us about the names that they trimmed.
Yes, so we care about these titans of the industry, billionaire investors. They sold some of their stake. George Soros sold some of his stake in Alphabet and Amazon. So some prescient moves there. Stanley Druckenmiller sold some of his exposure to NVIDIA, also quite interesting. David Tepper, another family office investor, former hedge fund manager, cut some of his stake in Amazon, Microsoft, and Meta. So we do see some trimming of those tech positions ahead of what was a pretty significant sell-off.
We kind of discussed this 24 hours ago, Hema, but you know, they come thick and fast, the 13F filings. You see individual fund names that are stock pickers in particular. They go one way or the other. But in aggregate, was it a good second quarter for technology or a bad second quarter for technology in terms of going in and out?
Yeah, so I would say in aggregate, we did see some selling of some tech bets, which for the investors was a pretty good move ahead of the volatility that we saw. So we did see some selling of Microsoft, 140 hedge funds sold at that stake, some trimming of Meta, some trimming of NVIDIA. Apple, though, a popular stock buy, the most buying we've seen in about 3 months.
Unlike, well, the Oracle of Omaha. I'm interested in the Tiger Cubs that we talk about so much. What moves have they been making? Have they been making back any of the losses, basically, we've been so accustomed to of late?
Yeah, so their performance, we did see a little bit of a downturn during the volatility. Not terrible, but not great. Every month does matter when it comes to these funds that are trying to dig themselves out of a hole. But in terms of their 13F positioning, some interesting moves. United Health seems to be a popular buy for these funds. Tiger Global started a brand new position in that company. It's 7th largest holding. Coatue started a small stake. Lone Pine bought some as well too. So United Health did seem to be a little bit popular. D1 started a brand new position in XPO. That's a logistics company, and that's now D1's 5th largest holding. So we do see some kind of interesting moves on the margins in companies that are not necessarily traditional tech.
Bloomberg's Hema Palmer, thank you very much. Alibaba reported earnings, posting a disappointed 4% rise in revenue, even after aggressive promotions to try and drive spending. Joining us for more on the China tech earnings story is Bloomberg's Isabel Lee. The ADRs are higher, though, now. It's kind of interesting when you go from the Asian session into the US session. But overall, it's sales growth weakness that we're worried about.
It's slightly higher. I think investors have digested the news overnight, but they're still not that thrilled. The 4% rise in revenue, you're correct. It was a rise, but it was anemic, and we have profit plunging around 27%. Alibaba really has just struggled to drive its growth. We have Eddie Wu, the CEO, who was installed last year, making it his priority to focus on the twin business of cloud computing and commerce. He has also been making bets on AI in the long run. But investors have been worried that Alibaba's intense drive to beat its competitors, PDD and JD.com, will compress margins. And the three-way rivalry among those have been really intensifying for a while. And a little quick note, Alibaba's biggest rival, Tencent, reported better than expected earnings, but we did have the company warning of weakening consumption. And JD.com also reported better than expected earnings. So it's really Alibaba that's kind of in the backseat for now. But it's just one quarter, and zooming out, the economy in China is still not looking that fantastic, Ed.
I mean, it's interesting, just going back to the 13S we were discussing. We understand that Michael Burry, for example, has actually been beefing up his Alibaba stake. People do believe in a turnaround for this business. Is it all to do with ultimately a weak revenue stream, a weak consumer? Because they did seem to really put it away when it was GMV focused and indeed margin focused.
Yes, Michael Burry did increase his Alibaba stake by around 7%. And we also have David Tepper slashing his Alibaba stake for a little bit, but it's still the biggest holding in his company. And I think that's really the main question. Would you invest in China because now it's cheap? We have the other end, though, saying that they will not invest because it's cheap for a reason. If you zoom out, we have the latest data from China still showing an economy weakening. We have domestic demand faltering. We have property crisis that is still prolonged in slumping. So it's really not proving to be better. But then if you ask others, they're still seeing a bright spot. I mean, no economy goes up in a straight line. They see this as a blip in China's economy, but still believes that this second largest economy in the world will be a bright horizon someday.
I mean, as we're saying, David Tepper trimming by 7%, Michael Burry upping, some different views on individual names. But I'm interested as to, we were talking of Alibaba more of the rejuvenation, the reorientation, the dissecting of this business. What does the future look like? How are they managing to stabilize? How are they thinking about IPOs and the like? Any hints there?
With the IPOs, it's still unclear, but you can see Alibaba really making a big push into the AI space. So that's the good news. But the bad news is its rivals are also doing the same. And you see the same thing play out here in the US, the AI halo, so to speak. But now it's kind of fizzled a little bit. We have investors already questioning when they will see the payout of their millions of investments into AI. But in China, the same is playing out. Alibaba has made huge stakes into the AI industry, and so has PDD and JD.com. And that's why I think it will just always be a three-way rivalry for those.
Bloomberg's Isabel Lee on the China Tech Beat. Thank you very much. Let's discuss whether Alibaba's strategic adjustments could position it to recapture market share from the likes of PDD and other competitors now, with Jacob Cook, CEO of WPIC Marketing and Technologies. It's a firm which drives market expansion for global brands in China, but also Japan, South Korea and more. And it was interesting. I wanted to kind of start talking about the e-commerce landscape, but as Isabel outlined quite clearly, those same e-commerce names are increasingly thinking about cloud, basically, and AI. Good morning, the e-commerce market in China.
Yeah, good morning. It's really kind of gone from a two-horse race over the years between JD and Alibaba into a four-horse race now with China's TikTok, Douyin, and PDD. What we really like to think about the reports that came out as we've kind of digested through them is they're actually maybe a little bit disappointing on the overall revenue, but showed good growth in terms of GMV. And up until now, a lot of the growth from the competitors has actually eaten into a lot of that. So it's stabilized there. And it also stabilized with JD. That was a great result too as well. So in terms of that landscape, JD had a much shorter cycle in terms of changing what they wanted to do from the subsidies that they were giving away to consumers many years ago. to really operational efficiencies and getting closer and tighter supply chains. So that changed. I think we saw 92% increase in profit with them. So that was great. Alibaba's not through that transition yet. Eddie Wu's been very clear about that he's not really focused on bottom line profits yet until he gets a lot of this divergence and restructuring and stuff done. And we've seen, their GMV hold as well. And I think it was even up a couple of points. So that's been really good. And I think that tells us that they're probably pretty happy with where they are in their transition.
Jacob, how destabilizing for the global brands that you represent is it when a company such as Alibaba is doing a reorientation, a restructuring? How willing are they to stay with, to try and grow in China at the moment?
I think extremely well. I think Alibaba has always been a very good partner. The people that you end up engaging with as a brand out of their Hangzhou campus are actually very professional, and usually a lot of the best in the business in the individual categories too. But what was also announced is we're going to get a whole bunch more merchant programs too as well, and new ways to advertise. So we're excited about that level of innovation. Overall, customer acquisition costs have been fairly stable on Tmall, and they've been relatively attractive for brands to do that. It's been actually more destabilizing to have to really rush into these other trends at PDD and Douyin, which have completely different approaches to e-commerce.
In the moment, JD is the outlier. Shares are up significantly, right? Is it the outlier? Is there a point of difference in its place in that market and its strategy?
Yeah, it's a simpler business. It doesn't have all of the massive business units that Alibaba does, in terms of especially cloud computing being much larger. And they announced really what they were going to do with restructuring and stop with these subsidies and race for customers is really focus on operational efficiencies. They did go through a round of management layoffs a couple of years ago. And to us, what we look at is that sort of being very successful. And again, I think the differences here between the two of them is what's going on with Alibaba and how they're going to compete against in the new e-commerce landscape is a longer transition process. And I see them being about halfway through that right now.
What's your main piece of advice for a company that's wanting to access e-commerce growth in China right now?
I think my advice is to actually go for it. I know there's a lot of headwinds in the economy, especially due to real estate, but if you take away, luxury goods, which really isn't aligning with that new younger consumer that's more into Lululemon, and you take away durables, which are related to new home sales, e-commerce growth in China is still lower double digits. And we saw, a great 618 a couple of months ago, and we're all really optimistic about 1111 in a lot of categories, excluding the ones that I just mentioned.
Jacob Cook, CEO of WPIC Marketing and Technologies. We really appreciate the expertise. Thank you. Coming up, a closer look at how Google search might be providing the giant with the AI advantage. That's next on Bloomberg Technology.
Taking a look at Google, following the federal court ruling last week that Google is an illegal monopoly. We're taking a closer look at the search giant's influence with AI. Publishers face a choice between offering up their content for use by AI models that can make their sites obsolete and disappear from Google search, which is a top source of traffic. Let's break it all down with Bloomberg's Julia Love, who joins me here on set. What we're really talking about here is web crawler. In other words, a mechanism to go through a website's data and position it in search. And that gives Google an advantage because some of that data ends up in the training of large language models, essentially. Good morning.
Good morning. Yes, so Google has been at this for decades now. It crawls the web, millions of different sites, to be able to show a detailed index to users. But that now gives it an edge over search startups that are trying to get into the game because they want to crawl too. But many websites block pretty much everyone from crawling except for Google and Microsoft's Bing. And so startups are at a real disadvantage.
To choose whether or not to crawl, ultimately, Julia, there's also the macro perspective that regulators are really worried about this advantage that Google seems to have in the world of AI. They already think it's a monopoly in search. This might just double down on it?
Yes, absolutely. I think this underscores that this is just one of many advantages that Google continues to have in the AI race. Publishers face a difficult choice. They're very worried about the AI overviews that Google displays at the top of search and what that could mean for their traffic. But they worry that if they blocked the Google bot from crawling, then that will affect their visibility of Google search, which would just be a death blow. And that's a consideration that they don't face with search startups like Perplexity, where it's easier to just block the crawler.
Meanwhile, I think Overviews is going live in new countries today. Julia Love, brilliant to have you. Thank you. Now let's take a look at all of this in the context of the reports that Bloomberg has been bringing you about the Department of Justice considering breaking up Google. It would be a rare antitrust move. Let's bring in Sarah Olam, Senior Fellow at the Technology Policy Institute. And Sarah, we were just hearing about ultimately the fears that AI, the dominance that Google has in AI, just once again doubles down on its monopolistic traits that have already been seen. Do you agree with that? Do you think that antitrust and breaking it up could help?
Well, right now we're 10 days out after Judge Amit Mehta released a ruling on August 5th after a 10-week bench trial on US versus Google. And so the talk about remedies of possibly breaking up Google, that's all going to start September 4th with the remedies hearing. We can talk about what those remedies are being floated as, but we won't know what the Justice Department recommends until then.
We won't know, but one of the ideas that we reported is on the table, citing sources, right, is the divestment of data. If you read the story, the original report from Bloomberg's Neil Nyland, that's what is being discussed. Maybe you divest it is its own entity. Do you see a way that would work in practice, Sarah?
Well, what's interesting is Android was discussed at the Google Pixel event as being part of implementing Gemini in with search. The Android question is very interesting because it's a global market for Android, and the US market is only a fraction of who uses Android. It's not clear at all that Android is core to the general search question in the monopoly trial. So we can discuss whether that could help with remedies, but really what I think is more likely is that limits on exclusive contracts and defaults would survive or would be more reasonable within scope. But definitely people are talking about the operating system market, the browser market, how AI fits into everything. But one thing to note, though, is that, like Microsoft, the Microsoft case, like the AT&T case, it's going to take several years for this to go through appeal and remedy and settlements. So what is AI-powered search going to look like in 3 years, 4 years? I think that's an important question.
Sarah Olam, Senior Fellow at the Technology Policy Institute. Thank you. Now, coming up on the show, we'll discuss Elon Musk's platform X and whether it can recover from its advertiser loss. We get the Bloomberg opinion take. That's next. Kara.
Let's just look over in Amsterdam for a moment. Adyen shares absolutely soaring 11%. This is as the payments company is managing to win back investor trust. Remember, last year revenue slumped, shares absolutely plummeted. Now revenue growth is back on, more than 20%. We rally. This is Bloomberg Technology. A failing social network? Well, that's the hypothesis coming from Bloomberg Opinion's Dave Lee, saying in his latest piece that with the platform losing advertisers, even getting under increasing scrutiny from regulators, the social platform, quote, reeks of failing social network syndrome. Bloomberg Opinion's Dave Lee is here with more. And you use, reorientate a phrase from a pretty famous restaurant critic and repurpose it. Look, why does it reek of a failing social platform? For many, with the Trump discussion, it's one of the most active it's been for a while.
Well, this is a phrase that Anthony Bourdain, as you said, used to describe restaurants that were going under. And the way he described it is it wasn't that they'd go under overnight or even for a few months or a while, but there's something in the air when there's a place that isn't quite right. And I said that applies to X, formerly known as Twitter, of course. And it's for many reasons. I think what's happened on that network since Elon Musk took it over quite clearly is it's become almost a single issue network for Elon Musk's politics, this issue of the culture wars, as we describe it. And what is happening less on X is some of the communities that made many normal people want to use it in the first place. So if we're talking about football, talking about music, talking about books, whatever, those communities are finding it harder to interact with each other, and certainly no new people seem to be joining those discussions in a way they might have done previously.
And look, if you go to your own X page, you haven't been posting since 2023. But you were almost forced to re-engage with the platform for this story, and then Elon Musk re-engaged with you.
Yes, quite. So I haven't posted, for almost a year, and that was based on my feelings towards what my feed was showing me in terms of the types of content I was getting without following certain users. And I didn't feel like it was a... this is something that Elon Musk sent to me today, or mentioned me about today. I checked my screen time. It's actually an average of 19 minutes a day this week. And that was only because I downloaded the app to listen to his conversation, his interview with Donald Trump earlier in the week. So without that, which went on for almost a couple of hours, I think, my time on X would be very, very minute. I check in on it to see what's happening. I'm a journalist, of course. I need to do that. But in terms of engaging with the network, I think its usefulness has gone now, but I think it will continue in some form for a while. But in terms of this useful utility for people, I think that era is behind us.
Dave, as you know, I use X a lot. I spend a lot of time on the platform. I share a lot of my reporting. I don't see a lot of data supportive that video does very well when I show video to the content. And it's interesting, one of the communities that does well there is Tesla, of course. But your issue in the opinion piece is about advertising, advertiser flight and money. Does Musk even care about the advertisers? Is it even a priority for him to have revenue growth as a basic question?
I mean, look, we've seen what Elon Musk has said directly to advertisers in words that we can't repeat on air, only to then, a couple of months later, now sort of be suing some advertising groups in order to, say, punish them for boycotting the platform. I mean, look, I think Elon Musk is quite sincere when he says he doesn't care if advertisers don't want to advertise on his platform, given he thinks it's now this sort of this arena for free speech. But the problem is he'll need to care, right? I mean, this is a website that needs money to survive. As rich as Elon Musk is, it still needs to be a functioning business. And I think that's going to be Twitter's problem as we go past the election, because right now I think a lot of the attention on it is to do with the presidential election. Once the votes are counted, people may move.
Yes. I have a lot of questions about monetizing Grok or monetizing X through Grok and XAI. Bloomberg's opinion, Dave Lee. Thank you very much. Coming up, we're going to talk more about Tesla's self-driving feature with that analyst. This is Bloomberg Technology.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. A quick check-in on the markets. NASDAQ 100 is up for a sixth straight session. There was a 7-day run of gains that ended July 10th, and we've talked a lot about how over many weeks, actually, the NASDAQ 100 was under pressure. We're kind of bracing still for NVIDIA earnings on the 28th of this month, but now the 13F look back, some of the economic data is a factor. Those single names are quite interesting. Again, it's kind of backward looking. But if you think about the mega caps, there were notable funds, Soros, Druckenmiller, who cut exposure to certain mega cap names in the second quarter. Many increased their positions in NVIDIA, which is notably higher today, having gone past the high, which was, I think, July 18th. Tesla is also interesting, up 6%. Some funds increased, some funds decreased. No real news catalyst out there, but we're going to get to a really interesting conversation on Tesla and full self-driving in a few minutes' time, Kara.
Yeah, first, let's just quickly check in on a big mover today. Cisco rising after giving a pretty bullish revenue forecast for the current period. It's all about a rebound in orders, even though it, of course, announced plans to cut thousands of jobs as part of a strategy shift. Let's get to Bloomberg Intelligence analyst Woojin Ho. And Woojin, look, it's that inventory digestion that is now in the rearview mirror, but job cuts looking forward.
Yeah, hey, thanks, Caroline. So I think part and parcel in terms of the job cuts, I thought the first round of job cuts that they announced a couple of quarters back wasn't enough, and essentially they're trimming the fat on their legacy business to really drive up the cash cow of the networking business. Now, one of the things that they said on the call was that they're rediverting some of those cost savings to the growthier parts of the business, which is essentially the Splunk observability plus the security side of the business, which I think is the right move.
Woojin, good morning. It's Ed in SF. What's the Cisco story? You know, when Ian King was on the show yesterday reporting, it was about a company in transition. I thought that many quarters ago it was already a company in transition, more focused on software. And
Ed, you know, Ian is 100% right. The way I view, from a revenue standpoint, fiscal 2025 was going to be a transition year, just primarily because of the backlog headwinds. There's some residual backlog headwinds that Cisco is going through. But one of the things that they are trying to monetize is the data that goes inside the network. And that's one of the reasons why, or the main reason why they made the Splunk acquisition. Now, it's going to take, like any large acquisition does, it takes several quarters to really integrate into the system. And then with the hopes of possibly monetizing the data for faster growth and better margins.
Is there an AI story for Cisco? You know, if you think about some of the trading action, particularly June, July through August, maybe it was the idea that there isn't as much of one as we thought.
Yeah, so a couple of things to that. From a core networking standpoint, there was a small AI story. What they said on the call was that there was an additional $1 billion of orders. So that brings it to about $2 billion of total cumulative orders that they see to date. But from a revenue standpoint, it's not that small on a $56 billion base. But the longer term is, if we think that data is going to be gold to fuel these large language models, you know, Cisco is potentially in the nexus of that, right? Because data has to run through the network.
Woojin Ho, all things Cisco, we thank you. Now, let's just get back to Tesla. Ed, you were pointing us there a moment ago, because last month we spoke with Truist analyst Wiiliam Stein, who said he nearly crashed while using an older version of full self-driving in a Tesla demo car. He published a research note on the experience, claiming FSD just wasn't ready for the prime time. There was a lot of questions for Will from around the world and why he didn't try the latest update of FSD. So why didn't he film that experience too? He went back to the Tesla store. He took the test again, this time using version 12.5 and an updated iteration of FSD. His conclusion, look, Tesla's FSD version 12.5 was a fast fail. Will Stein, he's here with us. So why was it a fast fail?
Well, very early into my test drive, FSD took this car through a red light, making a left turn from the second to left and not turn lane. It's an illegal move. Didn't feel terribly unsafe, but clearly illegal. If I were driving the car and there were an officer there, I'm pretty confident I would have been stopped. So from my perspective, even though I didn't get in a crash, and it wasn't even safe for me to really intervene, it was safer for me to let the car make this turn. This was a clearly illegal move, so from my perspective, this was a fast fail.
Let's do this again, Will. The basics of the test. Where were you? Whose Tesla vehicle were you using? What was the duration of the test? And why did you not film it in full?
Yeah, let me address the last question first. I'm not a video vlogger or whatever. I'm not a social media personality, right? I'm an equity research analyst at Truist Securities, writing research for our institutional investor clients. Film or video is not a typical media that I operate in.
Okay.
Regarding the test, it was similar to the two prior ones that I did, and that included using a test vehicle from Tesla with the latest software that they had available at the time. It's in suburban New York, and it was about a 10-mile drive that I asked the car to take me on, just to a local spot close to where I live, and back. And that was the test. And in each case, there were different characterizations of how the car felt and the level of safety. But in each case, there were failures, making it really not, let's say, appropriate to think about full self-driving in the way that a robo-taxi would.
Well, a lot of people ask me, why are you getting this guy on the show? And you kind of answered that. You are a research analyst who provides research to institutional investors looking at Tesla. But what interested me is you are a semiconductor and AI analyst. And Elon Musk says on the earnings calls with some regularity, to understand our future as an AI or autonomous driving company, go and use it for yourself. So you did. My question, your thesis on the jump from your test to a robo-taxi future at Tesla, why do you not see it?
Well, it's just not obvious today, right? Now, the company is already generating revenue from FSD. It's one of the 3 major AI projects that we know about going on at Tesla. We believe there's significant value already embedded in these AI projects in the stock. So we think it's important to understand whether this works or not. My assertion is that it doesn't work today. That doesn't mean that Tesla can't generate revenue from it, and it also doesn't mean that they can't get there eventually. It's just not ready today.
And there is the crux of the issue. How important is it that we see robo-taxi in October?
Well, I think the idea that FSD needs to work is critical to the stock. In my opinion, only about a third of the stock's value is wrapped up in the automotive production and energy capture and storage businesses. About 2/3 of the value of the stock are wrapped up in these AI projects. So he's got to show something at this robo-taxi day. He's already pushed out that date from August to October. But if we have the supposition that robo-taxi will depend on FSD, that is not ready. So let's see.
Well, I'm an FSD user. I got version 12.5 the day it was released. I'm on 12.5.1.3 at the moment. It's not perfect. Today, I completed the dogleg at Lombard and Van Ness for the first time. Will you keep testing with this regularity?
I'll test when there's, let's say a reason, a major upgrade, or if there's a request by the company. Elon Musk told me to, is the way I like to say it, right? After Q1, he challenged investors to go try it. I did. We wrote about it. After Q2, same thing. The criticisms I got were around, hey, 12.5 is such a massive upgrade, you're missing the mark. You have to go try this newer one and see the improvements. And I did that. And I would say, improved in some ways, but still a critical failure in my opinion.
Wiiliam Stein, Truist Managing Director of Tech Equity Research, thank you very much.
Thank you.
Next, Singaporean state-owned investor Temasek spent billions of dollars in the second quarter buying shares in US tech giants. Just before the sector dropped in July, Temasek increased the value of its holdings in 11 big tech firms by $3.3 billion in the 3 months through the end of June. The majority of the increases went into 6 of those names: Microsoft, Apple, Nvidia, Alphabet, Meta, and Amazon. By the end of July, however, most of those companies saw their stocks slide amid concern about the extent of AI-related gains and also fears of a recession. OK, coming up on the show, we're going to be joined by Trae Stevens, Executive Chairman, co-founder of Anduril, and a big investor partner at Founders Fund. That's next. This is Bloomberg Technology. Time for Talking Tech. And first up, Apple pushes ahead with a tabletop robot. The company's moving forward with the development of a tabletop home device that's said to combine an iPad-like device with a robotic limb. The tech giant has several hundred people working on the new hardware as it searches for new sources of revenue. Plus, Nvidia is said to have scrapped millions of YouTube videos without consent from creators to train and develop its AI models. That's according to a new federal lawsuit filed in California. The AI darling allegedly instructed employees to use tools to download videos and evade detection in an effort to train its Cosmos AI video project. And fintech firm Klarna is said to be close in choosing Goldman Sachs to lead its US IPO next year. That's according to sources who also say the company is seeking a valuation of about $20 billion. Deliberations are ongoing. Details of the IPO could change. Kara.
Well, talking of companies that are currently private and doing some big rounds, defense technology startup Anduril has raised $1.5 billion in a new funding round and plans to spend hundreds of millions on a new facility to manufacture its rockets, its underwater vehicles, and other autonomous weapon systems here in the US. Tell us more about the deal. Trae Stevens, his executive chair, is co-founder of Anduril. Of course, you're a founders fund as well, which puts a big chunk of change into Anduril for a $14 billion market capitalization. The raising of funds is for manufacturing. Where will that be? Why make it in the US?
Yeah, the investment by Founders Fund officially makes it the largest position that Founders Fund has had in our 20-year history. So as the founder of the co-founder of the company, that's kind of exciting to be on both sides of the table there. The Arsenal 1 project is a significant undertaking for the company. It's kind of predicated by this recognition that our weapons inventory in the United States literally is missing a zero on the end of it. And we may be okay on day 0, stretched on day 30, but there's no way that we have the amount of equipment that we need if we were to go into an active conflict on day 300. What Arsenal is all about is putting our own skin in the game rather than asking the taxpayer to pony up all of the risk, and giving a head start, a leap into production of these systems at quantity, so that we're not asking the taxpayer to do that by themselves.
But the taxpayer does do it for legacy rivals. Why shouldn't they do it for you? Why do it on your own?
Right. That is the historical model. The problem is that is exactly what slows innovation, because the business model of the legacy defense industry is cost plus. It's let's wait until the government pays us to do something, and then we'll get some small amount of margin on top of that. This isn't the way technology innovation works, as you know. The requirement is to step up, put your own capital into internal research and development, and then you have to kind of take the position of betting on yourself, that the thing that you're building and developing is the thing that the customer is going to buy at the end of the day. And that's exactly what we're doing at Anduril.
Trae, good morning. I saw a post from you on social media about the location of the facility. I think you might have been facetious, but where will it be? Not San Francisco, but will it be in SoCal?
Right. I was frankly amazed at the amount of people that thought I was being serious when I said that we were deliberating putting it in San Francisco. We're obviously not putting Arsenal 1 in San Francisco. I think there are a lot of states that are very much in play. It just will come down to site availability, greenfield versus brownfield, and the incentives that we're able to get from the states to accelerate as quickly as possible into the program. So not sure yet, can't really comment any further than that, but hopefully we'll have more information in the coming months.
There are just so many people that credit Anduril as being sort of the leading defense tech startup, right? You talked to Kara really interesting about don't put the burden on the taxpayer to fund the growth of operations. But I'm trying to sort of build a timeline of when all of the big money from government does go to Anduril, and that there's an openness to just engage with Silicon Valley.
The culture is certainly shifting. We've seen tremendous moves since, honestly, SpaceX and Palantir were founded earlier on in the 21st century. Anduril is stepping into that wave. We have the benefit of being able to stand on the shoulders of giants that have done an incredible job creating that market space. I think the defense tech industry as a whole has seen a major boom that you guys have talked about quite a bit here on air at Bloomberg. The question is really about how much the government is going to be able to lean into picking winners, not in an unfair sense, but really in the sense of identifying the companies that are going to be able to scale to the size of the problem. And that's the focus that we've had since the beginning, is not on research and development projects, but on scaling into production requirements that the warfighter has. And that's a culture that's shifting over time as we move away from very high cost, low volume, legacy, exquisite systems into some of these higher volume, attritable assets in the autonomy space that we're focused on as a company.
How does the cultural change depend on who's in the White House? It's a sensitive question, but when you look at who's first put money into Anduril, well, J.D. Vance was one of them. He could be in the White House. Would that make a big change, do you think?
It's obviously like a weird conversation in Silicon Valley, because there's this kind of belief that defense is this weirdly Republican thing. And the reality is, for anyone that works in D.C., is that this is just completely false. Defense is a bipartisan area. As all the other bills are kind of drudging their way through Congress, the National Defense Authorization Act passes with a near supermajority every single year. I don't think we're affected at all by politics, whether it's a Harris administration or a potential second Trump administration. We're in a good place in either case. It's more about leaning into the things that the Pentagon needs and not really worrying about how politics affects that.
There is some state-level politics. Elon pulling SpaceX from Hawthorne in California. But Anduril's so core to SoCal story. I'm sorry to go back to it, Trae, but what do you make of that?
For us, the location of our research and development facilities is largely predicated on access to talent. It's really important that we have the ability to recruit and retain the best software engineers, the best hardware engineers that are going to be able that will be critical to us building the products that we're working on. So do I think that it would be just as easy to do that in places that don't have a critical mass of engineering talent? Not necessarily. We have no plan to leave Southern California as our headquarters at any point in the future right now.
Trae Stevens, Executive Chairman and co-founder of Anduril and a partner at Founders Fund, of course. Thank you. Now, coming up on the show, Sanjay Poonen, CEO and President of Cohesity, joins us on the firm's latest cybersecurity report. Caro, what are you looking at?
Quick check on some shares. Trading Lenovo on the higher side, 0.7% on the American depository receipts. Why? Better than expected quarterly profit. It's all about servers. It's all about PC growth too. This is Bloomberg Technology.
Almost half of companies need more than 6 days to recover data and restore usual business. That's one of the takeaways from Cohesity's latest report on cyber resilience. Sanjay Poonen, CEO and President of Cohesity, joins me now. And the reason DDoS or denial of service is definitely on the rise, bad actors are more active. Other conclusions from your research?
Yeah, thank you, Ed, for having me. Yes, we did a survey of 3,000 IT and security people in U.S. and G7 countries. There were three things that stood out. One, which I expected, which is 2/3 of the people surveyed said they've been ransomware attacked and they expect it to increase. But two things stood out. One was 2% of them believe they could be resilient in a day, and approximately 50% said they would take them a week to resolve. That's not acceptable. And the second aspect of it was almost 90% of them said they believe their organization would pay the ransom, and 75% of them believe the ransom will be over $1 million. That's also not acceptable. So, there's a treasure trove of data in what we serve, and I'm a data junkie. I found those three results to be somewhat alarming.
And therefore, they do what, Sanjay? I imagine they use Cohesity. But at what point, how do you get someone to be able to tackle this within a matter of days rather than a matter of weeks?
Well, listen, I think the most important thing we've learned from the CrowdStrike, Microsoft fallout, whether the formerly known as Twitter X was DDoS and the Microsoft DDoS attack, is we as an industry have to focus on resilience. It's a little bit like the healthcare industry, Caroline. When we all faced COVID, it didn't matter whether you're going to get COVID or not. The question was how quickly could you recover from it? And you almost have to plan for the fact that it's not just if, but when you get attacked. And you're going to probably get ransomware attacked. How quickly can you recover? Resilience is the most operative word. It should not take us days to recover from that CrowdStrike Microsoft fallout. It should be hours.
That environment must be good for your business, though. How's Cohesity doing? If the activity and the defense is on the up.
Well, Ed, we just finished our fiscal year. Since you asked me, I'll break it out here on your program. We had a record year. We closed our year at $549 million in revenue, growing 26%, which is the fastest among all our peers for the fiscal 24. And we turned free cash flow positive, which is the first time any of our companies. So profitable growth. As you know, we announced our intent to acquire Veritas, which puts us, when we close that transaction, pending regulatory approvals, as the biggest in our space. So business is good, and we're really, really focused on serving our customers.
20 seconds. You're going to go public anytime soon?
We have to close this transaction. That's step number one. But the anticipation is once we close the transaction, digest it, with the next stage is hopefully a public offering at the right time.
Sanjay, great to have you on. Sanjay Poonen, CEO and President of Cohesity. Some fascinating data. about his business and about the world of cybersecurity. But that does it for this edition of Bloomberg Technology, Ed.
Don't forget, check out the podcast. You know where to find it, on the Terminal, Apple, Spotify, and iHeart. The team in New York, the team here in San Francisco, that does it. This is Bloomberg Technology.